Okay, go ahead.
Excellent. All right, let's get started. Welcome, everybody, and thank you for making the time to be here today. My name is James Knape, and I'm a CPA, and I lead U.S. partnerships at Summ. We are a crypto tax and accounting platform used in over 180 countries by thousands of accounting firms and partnered with some of the largest exchanges in the world, which means digital asset tax is the world I live in. So here's my promise for the next 50 minutes. Crypto tax has a reputation for being a bit intimidating and murky, and I want to take that reputation apart. So, whatever your situation looks like, whether you were a client or holding a little bit of Bitcoin in one account, or you've got thousands or hundreds of thousands of transactions across 12 wallets and exchanges, by the time we're done here, you'll know exactly what the IRS expects of you, why it expects it, and the specific habits that keep you out of trouble and keep things simple. So, for this presentation, I'm going to keep this practical, less theory, not super heavy tax code for its own sake. So, the stuff that actually changes what you do. Because from my experience, about 95% of the problems people run into in the crypto tax space are really just variations of the same principles. So, the best way to think about crypto tax is like doing a puzzle with only the negative space. You are the client are going to give you their transactions, and from experience, the client rarely provides the complete info up front. So, your job as a practitioner is to piece it together using the negative blocks of space. And that's really the simplest form I could put it in. So, first, 30 seconds on who I am. I'm a former PwC CPA. So, when I first got into crypto, I actually spent time preparing the crypto tax returns and doing all the client calls and the discovery calls before I actually moved on to the software side. And now I lead North American partnerships here at Summ. So, point being, there is I've sat on both sides of this. I did the work myself, and now I spend all my days talking with holders and accounting firms who are doing this every day for a living. So, I'm not going to pretend like I've seen everything because I haven't. But between that time and the returns, the client calls, and the current conversations I have every day, I really could identify the same handful of mistakes that keep showing up. So that's really what today is. It's what trips people up, how to optimize your time expenditure as a practitioner, and then really how to give your client peace of mind on those crypto filings because it is a bit of a niche, it's a bit of a nuance. But once you get the principles, everything falls into line. So, one thing to know that this is the first three sessions I'm running this week, and they all build on each other. So, today is the foundation. It's the baseline that every single holder needs to know, no matter how complex your situation. Tomorrow, I'll go deep on that 1099 DA. And for those that don't know, that's the major new IRS reporting form you've probably heard about a few times. That deserves its own hour, and we'll do it tomorrow. And then on Friday, I'll walk through the entire compliance workflow, start to finish. So, literally from the first specific transaction in your wallet all the way to the numbers on the finished 1040 tax return. So, today stands completely on its own. You don't need the other two to get value from this one, but if you do find it useful, I'd love to see you guys both tomorrow and Friday. So, let's get into it. So, what you'll leave here being able to do. These are the four goals for the hour. So, first off, you'll be able to recognize a taxable event. You'll know precisely which crypto activity the IRS counts as reportable, and just as importantly, which activity is completely fine and does not trigger anything. So, a lot of anxiety in this space from the practitioner side and the client side just comes from knowing what that line is, and we're going to draw it clearly. The second pillar here is you'll be able to tell the difference between capital gain and ordinary income. And given the audience here, I mean, this sounds overly simple, but it's one of the most valuable things you'll learn from today because the exact same coin, the exact same asset can be taxed two completely different ways depending on how it came into your hands or your client hands. And knowing which it is directly affects what you or your client owe at your end. Third off, you'll be able to meet your 2026 filing duties. So you'll know how to answer the digital asset question that's now on the top of everybody's tax return. And you will know which specific forms your activity ends up on. And then fourth, but not least, you'll be able to actually keep the records that will withstand IRS scrutiny. Because here's the spoiler for the end. Almost every crypto tax return nightmare I have seen traces back to bad record keeping, and it is 100% avoidable. So, again, one quick note, this session is foundational by design. So, for those that are already deep in the weeds, have experience filing crypto returns, please don't tune out. Just think of today as a clean, correct mental model you can hang all the complicated stuff on. And for any experts that are here right now, feel free to jump in and make this collaborative. I appreciate any insights this group may share to educate everyone on the call. So, the big question and very important thing is what makes 2026 tax year different? And that answer is simple. And it's happened in other countries before. It happened in Australia about 5 years ago. The reporting era has officially arrived. So for years, crypto was kind of a blind spot to the IRS and they couldn't really see into it. So they dedicated resources, they've gotten experts, and those days are over. And their visibility in your activity has jumped dramatically. And yeah, on the next slide, I'll show you exactly what's changed. So in 2026, three things have changed. And putting them all together, they completely changed the game. And we will take this one at a time. So, number one, and you will hear this over and over, probably starting this year or next year, is the 1099 DA. And this is a brand new form. And what it is simply is for the first time ever, brokers, and by the brokers, I mean the centralized crypto exchanges you trade on. So, think Coinbase, think Kraken, Gemini, Crypto.com. Those are the major US players. So they themselves, as brokers, are now required to report your activity directly to the IRS. So right now, this tax year, they're just reporting your gross proceeds. Simply put, that's the total dollar amount of your sales. And the forms covering your 2025 sales are landing this year. So the reason you should care is it works exactly like a W 2 from your employer, or most simply the 1099B from your stockbroker. So, from a holder side, you have to understand that the IRS already has a report from the broker. So, your tax return should now match what the exchange told them. And if those numbers don't line up, the system will see it automatically. Now, one caveat I do want to put there is that your own record keeping takes precedent over that 1099 DA, because as I'll explain throughout this presentation, the exchanges don't have the full picture. Number two, the second pillar here would be the cost basis reporting. And here's a subtlety that matters is right now the exchanges are reporting what you sold for, but not what you paid. So the cost basis. And the reason that matters is because the difference between those two numbers is obviously the actual profit. And that is changing next year because the basis reporting phases in next tax year. So for assets you acquire after January 1st, 2026, you're going to have to report the basis. So that was the big gap the IRS held historically. They couldn't see what the crypto actually costs you. So that is rapidly closing and it will be closed out by the end of this year. And one thing worth flagging here is since it's brand new, the IRS just gave the brokers transition relief on the piece. That is notice 2026-20, and it's good through the end of this year. So even once you start seeing the basis on the 1099 DA, the IRS understands it's not going to match your own records perfectly for the 2026 transaction. So as I mentioned before, do not take the form's number at face value. You actually have to take the time as a practitioner to reconcile it and true up the numbers to ensure completeness and accuracy. Because at the end of the day, that's what the IRS cares about. And that leads me to the enforcement piece, which is number 3 on this slide. And this is really a piggyback on the first two. So there's going to be more data flowing to the IRS, which means more automated matching. So they didn't hire a bunch of agents sitting here that are scrutinizing you. They have a computer matching system. And I really want to reframe how you think about this, because on the consumer side, on your client side, they think audit is some dramatic event where the agent shows up at your door, knocks it down, and takes you off to jail. Obviously, you have to calm the clients down on the call, and everyone in this room knows that's not what it is. So simply just comparing two numbers on a computer. If the exchange, say Coinbase, says you sold $30,000 of crypto and your return doesn't show it, you're going to get an enforcement letter in the mail. It's really cheap for them to do. It's automatic, and it's starting to happen more and more now. I anticipate early 2027, there's going to be a tidal wave of it, which is why it's going to show up on more practitioners' desks. So bottom line, if you take nothing else from this slide, take this. The era of they'll never know is over. Completeness and accuracy are the only safe strategy. And the reason I say this is you will find that crypto holders really hold an ethos of crypto is not taxable. And they will sit there and they will confidently argue with you no matter what you say or what credential you hold. So if you have a client willingly reporting their crypto tax, please cherish them and never let them go. I have many stories and many interactions, and some of these characters who have lived in the crypto world for a long time, saying like 2007, really don't think crypto is taxable or traceable, and it's a pervasive thought pattern that I work to dismantle. So here's the good news. Underneath all of this, everything the IRS does with crypto flows is from one single idea and the one concept, which is not complicated for anyone in this room, um, is that crypto is property. So just think of it that way. And yeah, make sure you have that as basis understanding. So, as mentioned, crypto is considered property. And from a historic perspective, they made this call back in 2014. The notice was called 2014-21, and it still governs everything today. And I know property sounds abstract, so let me give you a little mental shortcut that makes it all easy. Basically, you just need to treat every coin like you own a share of stock, and that's it. So if you could remember, it's basically stock. You could reason the way into the right answer almost every time. And I'll walk you through it with a super simple example here. So say you buy one Bitcoin for $40,000. Step one, the moment you buy it, does anything taxable happen? The answer is no. You simply just traded cash for property. So same as if you bought $40,000 worth of Apple stock, nothing taxable occurred. But something really important did happen, which is you establish your cost basis. So that word basis is going to come up all day. It's really the spine of crypto tax. It's the most important thing. So let's go ahead and define that right now plainly. As many of you know, your basis is what you paid. It's your starting line. It is the number we'll measure everything against later. So in this case, your basis is $40,000. Now, step two, over the next few months, that Bitcoin goes to 60,000. So you're up 20 grand on paper. Do you own tax on that gain? No, because it's unrealized. So it only exists on paper. IRS doesn't tax unrealized gains. So as we said, think of it exactly like a stock. It's gone up, but you haven't sold. So you can watch it go to $100,000, back down to 10. As long as you're holding and doing nothing else, there's nothing to report. So in the crypto world, we call that round tripping. So for any crypto holders here, please take your gains. Now, when does something taxable happen? And that leads to step three, which is on disposal. When you dispose of it. Now, the nuance here is when you sell it, obviously that's disposal, swap it or spend it. So that's when you realize the gain or loss. And that's finally when you have something to put on your return. So the single sentence, that's the spine of the entire talk. Buying and holding is not taxable. Disposing is taxable. Everything else we covered today is just detail hanging off of that one line. Now, this brings us into what defines a taxable event. And let's get specific here because what actually counts is a disposal and what is totally safe. You'll see that on the left column in the taxable section. The right column is what's safe, and we're going to touch on both because it's pretty important. So, the left side, taxable events, simply put, selling crypto for dollars. That one, obvious. It's a straight sale. It's how stocks work. It's the most simple example in crypto. But the nuances here I do want to touch on, I do want to educate, is the spending crypto piece, because this one actually surprises people. So, as property, if you buy a cup of coffee or a car with Bitcoin or a house, the IRS treats it as if you sold the Bitcoin for the dollar value first and then spent the dollars. So, yes, the spending is a taxable disposal. And you're going to see more of this on the practitioner side with the emergence of crypto payment cards. So, our close partner is MetaMask, and they just launched a card with MasterCard. And I am seeing a huge knowledge gap from the consumer side that they are not creating taxable events while using it. These laws are subject to change, but as of today, every time they swipe that card, they are creating a taxable event, which requires tracking. Next would be the earning crypto side. So that could be getting paid in it or earning staking rewards. Both are taxable. However, they're taxed as income, not as a capital gain. And it works differently enough that I'm going to give it its own section in a few minutes. So we could go ahead and hang on to that one. But here's the actual big one. And the one I genuinely need you guys to walk out remembering. Trading one crypto for another is a taxable sale. So, although obvious to some in here, let me say that again because it is the most missed rule in the entire area. Swapping one coin for another is considered a sale. So, as an example, say you or your client, they brought Ethereum for $2,000 on Coinbase. Later, they go and they swap all of it for Solana when it's worth $5,000. So you never actually touch dollars, no cash hit your bank account, no stablecoin hit your bank account. So it feels like on the consumer side, you just basically rearrange things inside your crypto world. That's because you did. But in the eyes of the IRS, you sold your Ethereum for $5,000. So you have a $3,000 capital gain to report. And every year, this is the number one thing people miss. So I'm going to hammer it home here throughout the entire presentation that swaps are in fact sales and need to be treated as such. So the reassuring side, the easy side is the right column. These things are non-taxable events, so you can stop worrying about them. So as mentioned, buying crypto with dollars and just holding it is totally safe. We covered that. And here's a big one that causes a lot of needless panic, and it's called a transfer, aka moving your own crypto between your own wallets. So if you have Bitcoin on a Coinbase account and you move it to a Ledger wallet, which is a hardware wallet, it is not considered a sale. No taxable event occurred. So you still own the exact same coin. You just change where they're stored. And a lot of people, they see money moving from one to the other. They assume it's taxable. It is not. Finally, gifting crypto within the annual limits and donating it to a qualified charity. They do have their own specific rules, but they are not taxable sales to you on the crypto side. So the one sentence takeaway from this slide is the crypto to crypto swap that feels like nothing happened. It is a sale, and do not miss it. So that brings us to another principle, and that's the capital gains versus the ordinary income in crypto. And this is where the real money lives, and honestly, some of the confusion too from the consumer side. Because the same coin they hand you could have two completely different tax bills depending entirely on how it came to you. So on the next slide, we're going to go ahead and untangle that one. Let's go ahead and start with the capital gains because that's what you have when you sell the crypto you bought. I don't need to explain it to anyone in this room. This formula is refreshingly simple. So your gain equals your proceeds, aka the fair value of the asset less your cost basis, what you paid for it. So proceeds minus basis, and if you bought one at 2,000, sold at 5,000, your gain is 3,000. That's it. So one warning that ties everything together. If you cannot prove your basis, meaning if you can't identify a specific record to the IRS of what you paid, the IRS rule, and they will enforce it, is to zero out that basis. And this maximizes your tax liability. So if you think about what it means, if your basis is zero, then your entire sale is taxed as a gain. Working example, you sold $5,000 of crypto that actually cost you 4,000. Without records, you're going to get taxed on the full $5,000 gain instead of the actual $1,000 profit. So this is real money out of you or your client's pocket, purely on missing paperwork. And that is exactly why the record keeping section at the end matters so much. So we'll go ahead and hold that thought. So how much you actually pay on a gain, that comes down to one thing, and it's how long you hold it before you sold. And there is a clear, bright line at the 1 year mark. So if you held it for 1 year or less, it's a short-term capital gain. And I want to be precise here because this room will appreciate the distinction. Short-term gain is capital gain, and it will land on the Schedule D, nets against all your other capital gains and losses, but it gets taxed at the ordinary income tax rate. So the same rate as your salary. Simply put, the character is the capital, only the rate is ordinary. So don't let anyone tell you that a short-term gain is ordinary income. It's not, and the difference matters on how your losses offset it. Now, if you hold for more than 1 year, it's a long-term capital gain. And here's the word for the patience: is the preferential rates are between 0, 15, or 20%, depending on your income. So let me show you why that's a huge deal. Say you have a $10,000 gain held short term in a 32% tax bracket. That's $3,200 in tax. Held for just over a year at the 15% long term rate, that's $1,500. Same gain, half the tax. The only difference is you waited past the 1 year mark. So before you hit sell, it's genuinely worth checking how long have I held this. Last thing on the slide, and again, most complicated, most important, is that every sale also needs a cost basis method, aka an inventory method. And that's just the rule for which coins you are considered to have sold when you bought at different prices. So the two ones that sit in this house are the inventory methods: FIFO, first in, first out, and then specific identification. That's when you could actually take all the tax lots, choose what's most optimal. Again, we don't need to get into the details today, but just make sure you pick one inventory method and apply it consistently. I will touch on this in much more detail in Friday's session, so I'll just leave it there for now. On to the next one, and that is the ordinary income section, aka earning crypto. So, aside from the capital gains we touched on the last slide, the other way crypto gets taxed is ordinary income. And the trigger here is different because this is when you earn crypto rather than buying it. So, this happens in a few ways. Most commonly, it's being paid for work in crypto, which is increasingly common with stable coins or with Bitcoin, Ethereum, Solana. The second way you're going to see this pop up is earning rewards on crypto you hold. So think of rewards as an equivalent of interest earned in a high yield savings account. The exchanges are going to reward you for parking your money in there. They're going to pay you an interest rate. Those are called staking rewards, and that's considered income. So the mechanic I like to teach this on is what I call two bites of an apple. Because as previously mentioned, the same coin can get taxed at two different moments. And I'm going to go ahead and walk through that with real numbers. So Byte one is when you receive it. So say you are a client, get paid $1,000 worth of crypto for some work. The moment you receive it, the moment it's in your control, the $1,000 is ordinary income to you. This operates on the dominion and control doctrine. It becomes important with grants because what matters is you'll see certain scenarios where crypto companies will give you grants options, and it matters the day you are available to claim it, not when you actually do. So that falls under the dominion and control doctrine. And in special niche cases, you will see that pop up. So it's when it is available to you, when it's in your dominion and control. So even though you haven't sold anything, and even though you still are holding the coins, you earned $1,000 of value, and it's income just like a paycheck would be. So the most common part people miss here, and it's the most important link in this whole section, same $1,000 becomes your cost basis in these coins. So the income you just recognized separately on a Schedule 1 sets your starting line for the future on any future sale. And that leads us into byte 2, which is when you later dispose of it. So say those coins grow that you received as income, and 6 months later you sell them for $1,500. So that creates capital gain, but only for the $500 of growth since you received them or had dominion and control, because your basis was only 1,000. So like other things in the TradFi world, you're not taxed twice on the same 1,000. Byte 1 tax the 1,000 as income. Byte 2 taxes only the new $500 as a gain. So here there's two separate distinguishable taxable moments: income when you earn, capital gain or loss when you dispose of it. And here's why the byte 1 is so critical, because it's very common for a client to forget to record that income at receipt, and your basis will stay at zero. And then later, when they go to sell it, they're going to pay the full $1,500 sale that looks like a pure gain. So you'd overpay. The only thing worse than overpaying is creating the headache of misreporting. So the number one rule is to catch the income the moment you receive it. And for your reference, on the form reporting, these types of transactions will be reflected on the Schedule 1 form. So let me pull this all together into one fictitious story because you'll see it happen. It's a rather simple example, but very common. This happens to one person across 1 year. And I find in teaching that this just helps it click a little bit easier. So in this scenario, meet our friend Dana, and we can watch how the same person hits all three concepts we covered in 1 year. So in January, Dana buys $5,000 worth of Ethereum. What happens tax wise here? We mentioned it. It's nothing. It's just a purchase. So no taxable event occurs. The important part, though, is she just set her basis at $5,000. That's a good thing. And that'll come back later. So later that year, a few months later, she earns $400 worth of Ethereum in rewards. Um, what happens now is the byte 1 example. That $400 is recognized as ordinary income right now, this spring, on the date of receipt, even though she has not sold a thing. And that 400 becomes her basis for the new reward in the coins. And that part is extremely important. Earned income, Schedule 1. However, establish the cost basis on that earned income at $400 for the future capital event. So that brings us to later in the year, in November, where Dana goes and decides to swap all her Ethereum for Solana. And by now, the Ethereum is worth $8,000. So it's important to remember a big rule here that a crypto to crypto swap is a sale. So Dana has a capital gain to report. And because she held for less than a year, it is a short term capital gain taxed at her ordinary income tax rate. So just zooming back out here, look what could happen in one ordinary year for one ordinary holder on a super simplified example. We had early in the year a non taxable purchase. Secondly, a few months later, shot of ordinary income. and then finally a capital gain later in the year. So that covers three tax rules: one on the property, one on the income, one on the capital gain in a single person's year. So if you follow Dana here, you get the whole framework. And the nuance in between this that's not covered on this slide is you're often going to see transfers between different wallets and exchanges, which again is not a taxable event, but can create confusion for new practitioners that are not crypto native. Big thing here. Next topic is kind of where the holders tend to struggle. And let me go ahead and save you some real pain right now, because out of all the crypto returns I have seen, there are four common mistakes that make up most of the issues. And if you fix nothing else from today, just please identify these forms, or excuse me, these four, because although they may seem overly simple, again, given the audience especially, a lot of the issues are just derivatives of these four principles. So, number one is something we've hammered already, and I'm going to keep hammering it because it is such a common misconception that swaps are not recognized as capital events. But again, it's number one for a reason. So, if someone trades their Ethereum for Solana all year, or Solana for Barking Puppy on a meme coin, which does happen, but they never cash out for dollars, they genuinely believe they own nothing and they may not report it to their practitioner. So that goes back to the negative space kind of example we used on the first slide, where you as a practitioner, your onus is to recognize the data, really get it all in one place, and identify on behalf of your client, hey, I think something's missing, because that tax bill is very real. And crypto to crypto is the most missed taxable disposal by far, and your clients are often convinced that it's hidden. Um, just as a little caveat here, there are a lot of black hats in this industry giving tax advice for their students. And the black hats are not CPAs, but unfortunately, they have a lot of influence in the space. And you will run across clients that argue with you and say things are not taxable when they are, and they will get creative with their justification. So be aware of missing data, be aware of clients not bringing everything to the table, because a few of them are taught that things aren't taxable when they clearly are. But, anyways, this brings us to number two, which is forgetting income at receipt. So, someone earns crypto rewards all year from staking. They never record the value they got. And now, circling back to byte one, their basis is wrong on every single coin, which is fine in the moment. But when they go to sell it later, their sale is miscalculated and it compounds from there. And in the Dana example, it's super simple. It's one transaction, it's one holder, but you're going to come across holders with hundreds of thousands of transactions. And then they're going to come to you on April 14th or October 14th and say, hey, I need you to fix this for me. And by that time, I mean, you're just going to have no choice but to file an extension. So that brings us to number three, which is losing basis across platforms. So this is a huge and sneaky use case of a crypto tax software. So you're going to have a client and they move coins from Coinbase to Kraken or to their own wallet. And the record of what you originally paid does not follow the coins, because these are all separate companies and they don't talk to each other. So you buy something on Coinbase, transfer it to a Kraken, 2 years later you sell and you can't prove the basis. And as you guys remember, the IRS is going to look at you and say you're going to have to take it as a zero. So when you have to deliver that news to the client, they're going to make it your problem, even though it's their record keeping issue. So it's something I do want to raise. And finally, last but not least on this one is answering the tax return question wrong. So just checking no on the digital asset question on the top of the 1040 when you actually did transact. A lot more common than you think, because in the old days it slid by. But now with the 1099 DA data flowing in, it's a discrepancy that the IRS can identify instantly. And there's no getting around that. So that's actually the perfect bridge onto the next section, which is your 2026 filing requirements. So let's get concrete about what you actually put on the return this year, starting with a question you literally cannot avoid, and many, if not all of you, saw this year. So this is the question every single US taxpayer had to answer this year, not just for crypto people, literally everybody. So reading it correctly, exactly as it appears, is at any time during the year, did you A, receive as a reward or payment for property and services, or B, sell, exchange, or otherwise dispose of a digital asset or a financial interest in a digital asset? So notice how broad that one is. The quote, receive as a reward or payment, that is the earning side, the Schedule 1 item. And B, the sell, exchange, or otherwise dispose of is the disposal side. And the exchange explicitly includes those crypto to crypto swaps we keep talking about. It's written to essentially catch everything we've covered today. Because as everybody knows, the IRS does not like leaving money on the table, and they could come back years later and get it. So, about this one, here's the part people don't appreciate. And this question sits at the very top of the 1040, right near your name, literally right above where you report your income. So it's not buried in some obscure schedule. It's one of the first things on your entire return by design. So the IRS did that on purpose because they want it to be unmissable and they want to catch the liars, because that omission is the number one trigger of enforcement letters that are starting to go out. The IRS is forgiving. They know this is new. So as long as you give a good faith effort and don't lie, you're going to have some leeway. So the three quick things are: one, please make sure your client answers it honestly. If you sold, swapped, spent, or earned crypto this year, the answer is yes. Two, from a conceptual standpoint, understand it's a cross check. So your yes or no gets matched against what the exchanges reported on that 1099 DA. And three, understand that a false no is the cheapest possible catch for the IRS. So if you check no while an exchange did report your sale, you've handed them the easiest discrepancy they'll see all day. So don't let your client get tripped up by the very first thing on the form. As I keep mentioning, this occurs way more frequently than you would think. In America, consumer compliance is still really far behind the other countries we're in. And as we've learned from American history, Americans are not a huge fan of taxes. So be wary of that in the crypto space, because a lot of holders just simply do not like to report. Now, another one, for as a practitioner, it's important to know is where your activity actually lands. So I'm going to demystify the paperwork here. And the good news is it's pretty simple. There's only three forms. And I want you to know how they map, even though I'm not going to make anyone fill them out today. We'll get into that Thursday and Friday. The first most important form would be Form 8949. And the simplest way I could phrase this is as a detail sheet. So every single disposal goes here line by line. So you're going to need what you acquired for, what you sold it for, the dates, and then the resulting gains or losses on the transaction. And here's where the reality bites. If you got 100 or a few thousand or a couple 100,000 transactions, this form genuinely becomes unmanageable by hand. So that's the moment most practitioners or individual users realize they need a software. And we'll come back to that. Again, this is not an ad, but it's the reason I actually ended up switching sides of the desk, because it is extremely hard, if not impossible, to do this in Excel, and at the very least, very inefficient on the billing side as a practitioner. So the second form here, the easiest one, is just the summary form Schedule D. So this is just a flow through all the totals and all the line items from your Form 8949 flow up into the Schedule D along with your other capital assets in the portfolio. So it's where your short-term and long-term gains and losses get netted together and create one final number. I'm sure everyone in this room understands Schedule D, even the non-crypto native people. So finally, we have a Schedule 1, a Schedule C. So if your crypto activity does rise to the level of an actual business, is where the ordinary income was discussed, which would be the Schedule C. Otherwise, the earnings side gets reported on the Schedule 1. It's just a different bucket for your gains. So once again, I'm deliberately not walking you through the filing line by line because that's exactly what the Friday session is for, the full end-to-end workflow. For today, just want to map in your head. Disposals go on the 8949, flow through to the Schedule D. Earned income, staking rewards, or salary, they go to the Schedule 1, and that's where everything lands. One detail caveat I do want to discuss is that Form 8949, even if there's no gain on it, the IRS requires completeness as well as accuracy. So if you have a stablecoin receipt that's just a one-to-one match, that needs to be reported on 8949. And I have seen 8949 report forms that are 70 pages long. So that is just something to be wary of. Completeness matters just as much as accuracy. It is one of the important things to educate your clients on as well, because they think if they just pay an aggregate balance, they're good to go. They're still going to get flagged because it's incomplete. So 2 prongs: completeness, accuracy, and you're generally good to go from there. Next up is habits that keep you out of trouble. Um, and it's the most practical of them all because after doing this for a bit on both the CPA side and the software side, almost every single crypto tax problem I've seen is simply a record keeping problem wearing costume. So if you fix the record keeping, the tax mostly takes care of itself. So here's how you do it right. And a practice I like to call is wallet hygiene. So the single most important principle here is the 3 words: as you go. So when building your paper trail, do it throughout the year because you may owe quarterly tax payments. So don't wait until April. Don't wait until 7 years later trying to reconstruct it from a fading memory. And there's another issue here. Some of these exchanges, like Celsius, went bankrupt. It's a little brutal to get those records, but the IRS does expect to reconstruct it, aggregating all your balances dating from the date you entered crypto. So that's something that can be avoided if you actually practice hygiene throughout the year. So that's habit 1, which is capturing every transaction. So for everything from a buy to a sell to a swap to an income event, record the 4 things: the date, the dollar value at the time of acquisition, cost basis, and what the transaction actually was. So decipher between a transfer, a swap, a buy, a sell, a fork, a liquidity pool transaction, all the fun stuff. So if you have those 4 things, no matter the transaction, you're always going to be able to produce a correct return. If you don't, you're guessing, and your tax optimization is going to go away because the IRS is going to require you to zero out that basis. The second habit here is to reconcile across every wallet and exchange. So do not rely on one platform's partial view because no exchange sees the whole picture. So what you're going to need to do is pull the complete history from each place you touched. In my experience, the single biggest source of errors and the pain point for the practitioner, because people file off of one exchange's data, usually whatever they sell on, and they quietly leave out 90% of their activity that went on in the background. So this is what creates the puzzle I referred to earlier. And again, the utility of a software, because it's going to highlight that missing data, and the client's going to need to spend time finding their missing wallets and exchanges. So having a client do this on the first time is exceedingly rare. And it's why it's important to not take that crypto client on April 14th, because you're going to have to go back and forth. As a practitioner, you're going to find missing wallets and exchanges, and the job's not done until that's done. Now, habit 3, and this one is new because it changed recently. You have to track your cost basis wallet by wallet. And what that means is formerly you could pool all your bases together across everything you owned from wallets and exchanges. So that was called the universal method. So working example, you could pull a Coinbase buy and apply it to the cost basis to a Kraken sale. which optimizes the tax treatment. But as of 1/1/25, the IRS ended this. So for now, each wallet, each account stands on its own for basis purposes. And technically, it's under Revenue Procedure 2428. And then practically two things is you can't average your basis across your whole portfolio anymore. And when you move coins from one wallet to another, you have to make sure that the original basis travels with them. This is genuinely new for the era, so it's worth flagging to anyone who files on your behalf, specifically the practitioner. And then habit four is to pick one inventory method and stay consistent, whether that be FIFO or specific identification. Make sure you choose one and then apply it that way for every year, because the IRS expects the consistency there, and flip flopping it will invite scrutiny. So I'll be honest with you, doing this all by hand across a dozen wallets and exchanges with thousands of transactions is inefficient, nearly impossible to do perfectly. That's why crypto tax softwares are getting popular. So what they do is they'll pull every source together automatically. They'll track the basis, cross transfers, generates the 8949 for you, auto categorize, tie things together, and just really increase this efficiency. And I'll say this plainly, whether you use us or a competitor, or a spreadsheet and a lot of coffee, the discipline is the same, and just keep the records as you go. So the structural audit flags to avoid is it's just a mirror image of the good habits. And if you're running short on time in your own filing, these are the four to check first, and I'll run through these quick. The biggest one, the big one, the new one is your return doesn't match the 1099 DA. The exchange report of sale that isn't on your return. As we said, it's going to be an automated matching process that catches this one first and fastest, and that's the client that's going to get the notice first. Flag number two is going to be that missing cost basis. So remember what that triggers. The IRS will treat it as a zero cost basis, tax the entire sale as a gain, painful, completely avoidable, and it's going to be an unhappy client that's going to make it your problem. Flag number three is going to be unreported income. So crypto you earned that never made it onto the Schedule 1. The earning side is easy to forget precisely because you didn't sell anything, but it is still income. And then flag number four is that inconsistent methodology. So switching your accounting method year by year with no explanation. Here's the encouraging part is that every single one of these is completely preventable with the four habits from the last side. So none of them are bad luck. They're all in our control. It's just paperwork. And currently the market is supplemented by crypto specific CPAs or non CPAs that are just recon experts. And then they do that. They generate these forms, pass it to a traditional CPA. And as crypto and stablecoins become more mainstream, this is going to have to change, for an all-in-one shop for a practitioner to find a solution. Because